Hello, hello.
I didn't join the meeting.
Oh.
Mic check. Mic check. Hello. Turn it on. You turn. Hello.
Hello, mic check.
Good morning, all. Thank you for joining. We'll start in another 5 minutes.
Yeah, hello.
Hello. Hello. Check. Hello. Am I audible? இல்ல ப்ரோ இங்க பட்டன்.
எல்லாம் ஒண்ணு.
Hope we'll start with the webinar. So So sorry, it's like the mic was on mute. So I was saying it's like as we all have some bigger aspirations, like some dreams are big, some are let's say for example like buying a dream house, sending your children to the best universities, or even retiring early to live a life of freedom. Other dreams, suppose for example, are smaller but yet meaningful, like taking that long-awaited family vacation or pursuing a passion project. But here's the thing about all the dreams: they need a direction and discipline to become a reality. That's where a financial planning steps in. So, at its core, financial planning is not just about numbers or just about investments. It's about giving your dreams structure, ensuring that your hard earned money works for you, and creating a roadmap that takes you from aspiration to achievement. So, in a world where a lot of uncertainty is there, and let's say, for example, having a personalized and well thought out financial plan is a foundation that helps you stay focused. So the truth is, no matter how unique your journey is, a financial plan can align with your goals and help you build your, let's say, whatever aspirations are there and give you the peace of mind that you require. So in today's session, A Thousand Dreams, One Financial Plan, it's decided or designed to break down this journey for you. And we'll talk about very basic things. And at the end of the session, we would like to know more about from your end. Let's say, what are your financial goals and what are the queries that you have regarding them. So to start with this session, I'll pass on to my colleague Janakira.
Thank you for that intro, Vinayak. So now we'll speak a lot more on, your goals, how to get to them, how to kind of strategize towards them, and how to maybe even form a goal if people are looking at that. Okay. So to begin with, I would like to start with a quote. Uh, when we kind of took a survey of the employees in our offices, what we kind of found out was that a lot of them, even though they were working in the field of finance or more closely with personal finance people, their finances had a lot of question marks, a lot of blanks in place. It's just that they were saving, they were still investing, but they didn't know what they were saving towards or what they were investing towards. So that is what this kind of presentation aims to solve, where we want you to take charge of your finances before they take charge of your life tomorrow. That is the main quote of this. That is what we'll be going towards. Now, to start off with, let's start with some questions. These are questions that people in office had, people when we've had presentations in the past, and these are very common questions. First one is how to start taking action towards your goals. See, action necessarily does not have to be saving money or to be investing. This might be taking an insurance plan. This might be setting up an account. This might be writing a will. So all of these are part of the personal finance journey. Second, coming to the more minute aspects, people are actually not aware of how much they save or how much they have, because we recently came across someone where they were saving close to 70-80% of their monthly income, but since they were not aware of how much they're saving, that anyway got spent to discretionary uses, to buying new things, and as such. Thirdly, how can people meet their financial goals? See, the purpose of saving or investment is to get you there. What should you do to get that? That is what this presentation will be aimed at. Fourthly, now we talked a lot about financial goals. Are we really prepared for a setback? In case of a setback, are you someone who's okay with postponing your goals, or is it a high priority goal that 100% requires you to get there? Lastly, what are the problems and how to overcome them? Because if you're able to overcome these problems, I think that shows character, that builds a little bit of character, which will kind of help you in your financial journey. Now, let's start with some of the common financial problems that we face. First one is, see, these are problems that may not be something that you created, but it has been thrust upon you. It might be family commitments, meaning, you might have a sister's education or wedding to take care of. You might have your parents' health to take care of. You might be the sole earner. You might be the sole breadwinner of your family. So all of these things are going to be there. It is investments or savings or personal finance is not what we do. Apart from this is what we do, including these things in place. See, these are responsibilities and commitments that whether we like it or not, some of us are forced into it where we'll have to put together. It's just that how do you make the best use of the rest of life? Second is existing debt. So this might be debt that you've taken. This might be debt that your parents have taken and it's been passed on to you. The obligation now lies with you to kind of fulfill it. Of course, certain years of your life might be spent on repaying it, but rest assured, even after a 5 6 year delay, I've seen people create a substantial amount of money because once that debt is finished, they come out with a vigor where they kind of start investing with an even more kind of aggression. Third is personal loan and credit card debt. These are things where, out of our own doing, we might be stuck in these things where short-term gratification of certain kind of products or things or vacations or fear of missing out on. So whatever it is that has led us to taking personal loan and credit card loans, for all intents and purposes, it is best to avoid these things. There's no reason for people to take it. So it is best to stay away from this. If you have money, you buy it, otherwise you don't. Lastly, not having an emergency reserve. This is what leads to a lot of people dipping into their investments and taking out the hard-earned money that they spent a better part of a decade building. So having 6 to 8 months of emergency funds is always recommended, and I think that will take you guys a long way in maybe coming out of some of these problems. Just a small thing that we've noticed is personal finance is never a winner's game. It's mostly people who avoid small mistakes, who avoid the bigger mistakes, who avoid, not taking out big loans, not paying absurd interest, not putting your money in questionable investments. I think if people are able to do this for a period of time, let's say 10, 12, 15 years, the wealth creation does not become a question, it becomes a certainty. So that is where the kind of avoiding big mistakes kind of thing comes from. If you avoid big mistakes for long enough, I think you'll eventually make pretty good wealth. Just a brief on some of the pillars of finance. Uh, First is always earning. So if you're able to upskill in the early stages of your career or upskill, after like a mid-career break or let's say a mid-career kind of pause, that's always good. Earning always comes first. Second, whatever you earn, you try to save maybe 30, 40, 50%. So, at least 25 to 30% is a good thing to start off with. If you're able to do that, I think you're on a good track. Thirdly, insurance. You do insurance so that the next thing that we come to insurance is intact, because as long as you have your contingencies taken care of, health as well as life, investments can go on without being uninterrupted because your income is going to take care of your expenses. Any contingencies, your health insurance and term insurance are going to step in. Lastly, you borrow and you borrow smartly. So how do you borrow smartly? You borrow for things that don't depreciate. So you don't borrow for a car or a phone or things like that. You borrow for a home. You borrow for an education. Those things appreciate. Those things pay dividends in a much higher way than a car or a borrowed money phone can buy you. So if people can get these pillars under control, I think they'll be on their way. Why set financial goals? See, setting a target is very, very important. Whether you're getting there or not, let's come to that problem on a later date. First, once you set your financial goals, this will help you prioritize which goals you need to get to and which goals you don't, which goals you can actually postpone. See, if there's a goal of planning for a house, but there's a goal of buying a house or upgrading your appliances. I think most of us will choose, okay, I'm going to postpone the buying a car and the buying the phone, and I'm going to put all my money towards buying a house because that's an asset that is going to stand the test of time. So prioritizing it, you'll only get to know once you note down your goals, once you jot down your goals. Second, it gives you investment direction. Now I know that buying the house or providing for my children or for making sure that my retirement is smooth is going to be my primary goal. How do I plan towards it? So now my horizon is set. What kind of investment direction am I looking forward to? Third, now that my investment direction is completed, I want to choose the right financial products. So now that I know my goal is maybe a little bit long term, maybe 5 years, 6 years, 7 years away, I want to be invested in those products that will get me to that goal, not products which I think will get me to that goal. You see, all of these start with you starting off with your goals, prioritizing, which will give you an investment direction, which will again provide you with the products to get there. And lastly, by this way, you get to your life's key milestones. So you're on your way there. So this is why setting financial goals is of utmost importance. Uh, Now, let's just take a case. List down some of your financial goals. So we conducted this exercise where these are some of the common financial goals like by building a house, buying a car, traveling abroad, emergency reserve, education, financial independence. These are some of the common financial goals that we see. So no particular order, but let's just, from a layman's perspective, let's just try to prioritize them. Let's just put them in a list. Now, things like emergency reserve, financial independence, education, they take a much higher seat than even things like buying a house or buying a car. Because if these things are in place, it affords you the opportunity to earn more to get to a house or a car. So to have that opportunity, you have to invest in certain things. That is what these things are. An emergency reserve is going to make sure that you don't dip into your investments. Education is going to make sure that you're able to earn more so that building a house and buying a car, instead of the 5 year period, it comes in a 2 year or a 3 year period. So investing early on in your career in certain things like this is much more valuable than putting your money towards a 20 year or a 30 year home loan where a lot of your capital is stuck in that one goal. It is not that we are advising you not to go for that goal. It is just that certain goals, if they take a backseat in early stages, let's say 30, 35, I think it will make a little bit more sense where it will give you that flexibility not only to earn more money, but to experiment as well. Just a short thing on short term, medium term, and long term goals. I see a lot of people miscategorizing it. So short-term goals are anywhere from 1 to 3 years. Medium-term goals are anywhere between 3 to 7 years, and long-term goals are 7+ years, or 5 years, 7 years, 10 years. That's where those goals come in. So short-term, maybe you're saving for a vacation, maybe you're saving to buy a new phone next year, maybe you're building an emergency reserve. Medium-term goals, these are things like upskilling. You're making sure that you have a bigger down payment for your house so that you reduce on the home loan. You upgrade to a better car. These are all pretty good things. Child's education. Longer term goals are goals that have a pretty kind of set strategy in place where things like retirement, achieving financial independence, you can take a little bit more risk. What we see is people think, okay, if I'm gonna keep saving and investing, what is the time to enjoy? Is that going to be no fun in life? See, that is what I think we differ a little bit in that we kind of like to take something called, save a little bit of money each month and you put it towards something called a fund. This can be a separate bank account or a separate, mutual fund or a debt fund where this money is just going to stay there. And whenever you want to go on a vacation, whenever you want to take this money out to splurge, this money can be a very, very good thing. A lot of Gen Z people do this where they kind of put it in a separate fund. And let's say they want to splurge on a weekend or they want to go and buy a new phone or a handbag or a purse or maybe a cosmetic item. They take it from this and they utilize it. So this is where that comes into place. Now, we looked about goals. Let's see some of the common financial mistakes to avoid. First is these are things that is not how not to plan your finances basically. See, setting a goal is one thing. Setting an unrealistic goal is one thing. If I'm gonna say I'm gonna earn a crore in the next 3 to 4 years, but I'm gonna only put in let's say a lakh a month or a couple of lakhs a month, then the amount of money that I will need to put in is restricted. Then my timeline should also increase, but I don't see that happening. What people increase is the rate of returns. So people go for absurd rate of returns like 30%, 40%, 50% on their investments to get to that target. What usually happens is neither they get to the target nor they're able to build whatever they could have built if they had gone for a slightly more conservative approach. So this is what we usually see where people make a lot of common financial mistakes where they know certain targets and certain rates of return are outright not possible, but they still go for outright not possible in the time horizon that they've chosen, but they still decide to go for it. Greed is a human emotion that is part of all of us. Controlling it will help us, make it big on our investment journey. So setting proper financial goals is very important. I'm not saying don't let these goals be outrageous. Let it be outrageous, but also set a timeline, set a timeline that is more opportunistic, that is more relatable, so that you kind of get to these goals. Second is not having a budget, which will give you no idea on how much you save or how much you invest. And thirdly, no emergency reserve as well. So these three things in combination will make sure that they pose a very, very significant threat to your financial life. What we've seen is if people have these two things covered, having a budget and having emergency reserve, that itself gives them a sense of financial relief so that they're able to kind of think more clearly. They're able to maybe kind of decide more clearly. They're able to have a little bit more clarity on what kind of money is coming in and what kind of money is going out. Emotional decision, delayed EMIs and ignoring insurance needs. Uh, Going on, a spending spree or going on maybe, impulse purchases. These aren't outright bad things, but if the decision to go on these things is very frequent, I think that will have an impact on your uh, financial life. And things like delayed EMIs and ignoring insurance needs are things that outright should be not even happening in the first place, because if you've taken a commitment, I think it makes sense to kind of finish it. An EMI is can be a good thing or can be a bad thing. If you are maybe saving for something like a sorry. So if you are saving for something like maybe a car or a kind of a house, I think the EMI is something that is unavoidable. But you delaying it will cause a kind of negative impact on your CIBIL score. So those things, if we can kind of keep in check, that will be better. These are sanity checks or housekeeping checks, so that when we go into major things, these will kind of the foundation will be held in place. Lastly, something I've seen a lot of, not even young people, but a lot of people who are in their mid 30s, mid 40s as well, is the herd mentality. Influenced by things like social media, people going behind options, futures, people going behind unrealistic investment expectations. So these are things, if we are able to kind of avoid it in the first place, see, creating sustainable wealth is what a financial plan will help you. Uh, Using a conservative estimate approach, if you are able to get to a goal in a conservative aspect, if you're able to get a percentage or two returns more, you still get that in a much shorter cycle. Maybe a 10-year goal, you get to a 7-year goal. But trying to do a 10-year goal in a 3-year or a 4-year thing, that is where the real problem comes in. That's where outright expectations become unrealistic. Now, we all know the story of Abhimanyu in Mahabharata. So he knew how to go into the Chakravyuha, but he didn't know how to come out. So that is where this kind of thing comes in, where getting into some of these products can be a mistake in the first place, and you are trapped. You can't even get out. Things like ULIP, there's a 5-year lock-in. Things like LIC policies, that's an even bigger lock-in, where even if you come out, you don't get anything. Options trading, I think that is a place where people have lost a lot of money to kind of speak with. We have data coming in from SEBI, which says that 96-97% of retail traders just end up losing money. So my question is, why get into these in the first place? People get into these because lack of knowledge of these instruments, being peddled by people looking for higher commissions, being peddled by people who are looking to make a quick buck. So these are instruments that, just like Abhimanyu, we should be very careful why we are getting into it. If not, we might not be able to come out. So no, the real thought comes to, can planning help you become wealthier? If the answer to that is yes, how is that possible? So now, since we have our housekeeping points in check, let's dive a little bit deep into how planning and how financial planning in general can kind of help you become to a better lifestyle. So first things first, getting a few things right will help you pay off. So what are these few things? These few things are very simple. These are things that we talked about: having a budget, insurance, making sure that I'm tax efficient. Uh, but with the introduction of the old regime and new regime, we think most people are good with the new regime, where taxation has been simplified to a greater extent. Diversification of savings, managing your loans and finances well, planning for your future. If you can get the first 5 things in place, I think the planning for your future part then becomes much more easier to do, because you have all your basic things in check. So now, moving on. Second thing would be, this is something that we wanted to explicitly include because we see a lot of people having this as a problem. It does not have to be credit card debt in thing, but credit card debt is something that we see a lot. But debt and leverage is being put to use by people in a wrong way. For example, taking a much higher car loan that is required. See, let's say you're buying a car that's 12 lakh. People usually go for a car loan that's 8 lakh or 10 lakh, making a down payment of, let's say, 10, 12, 15%. That's all. I think if you were to make a much higher down payment, let's say 30, 35%, maybe 40%, that speaks to your character. Not only that, your interest outflow is less. And if you plan to close that out in 3 years, the amount of money that you paid for the car in terms of interest, maybe you buy a 12 lakh car, maybe you end up paying 13.5 lakh or 14 lakhs, which is fair enough. But what I see is people usually stretch the tenure of the loan to 7 years or 8 years, where they end up paying so much that they could have bought a much, much bigger car. So even twice the amount. So this usually we talk a lot about compounding. Debt like this is usually negative compound, where your money is spiraling out of control, and this is where the unrealistic rates of return is actually possible because credit card debt is usually 2% per month, which is 24% per annum or 30% per annum, which this is compounding against you. And let me tell you, no investment in the world can compound against that rate. So being careful with things like this, with things like maybe chit funds, gold chit, all those things that are less regulated, I think it makes a lot more sense to be careful with these things. Just the last point, debt is a tool. Use it wisely. Use it for things like upskilling you, maybe buying assets that produce rent, to produce value, rather than on things that will kind of eat into your wealth creation. Leverage is a tool, not a necessity. Not everyone needs it. Not everyone should need it as well. Use it strategically to grow your wealth without ruining your financial stability. Now, to kind of take a little bit more on debt and to kind of give you a more clear picture, I would like to pass it on to my colleague Vinayak, who will kind of take you through a little bit more on debt, on ways to save, as well as on kind of how you can kind of plan better for certain financial goals, certain case studies, and we'll then open the floor for more questions. Vinayak, on to you.
So thank So thank you, Nakul, for giving a great introduction about what are the main checklists that we need for a financial planning, starting talking about the basics, emergency reserve, risk management, and everything. So one thing that we usually see as a query is about the loan and liabilities and so on. And let's say, for example, as Nakul also rightly mentioned, not all liabilities are bad too. Let's say, for example, there are some things it's like we do for our own appreciation, like we take education loan, or let's say we buy a property, or let's say commercial investment and so on. So still in that case, it's like there are few minor things that we can consider before taking a loan. So I'll just give an example to start with. So one thing is, let's say, for example, you take a home loan. So if you take a home loan for next 20 years, let's say at the age of 30 or 35 and so on, till the age of your retirement, you're committed to that. But suppose, for example, just by paying one EMI extra every year, you can bring down the tenure to, let's say, 15 years or 16 years. You can reduce it 4 years just by paying one EMI extra per year. There are a lot of strategies, but let's say, for example, explaining each of them won't be that helpful because everyone's, let's say, case study is different and everyone's requirement is different. So it's like even after the, let's say, webinar, we are open to connect with you and see it's like how we can help you out in structuring if you have any liabilities. Apart from that, secondly, it's like we have an interesting case study on the next slide. So most of us, it's like we have an interesting case study on the next slide. So most of us, it's like, let's say there would be a bucket list, or let's say having a dream of purchasing a car. Let's say, for example, a decent budget would be, let's say, 12 to 15 lakhs. So what we say is lower the EMI, it's like we are more happier. So suppose, for example, for 12 lakhs, for taking a tenure of 8 years, I'm paying just 17,200. But whereas for next 5 years or 3 years, if I take a, let's say, car loan, I'm paying almost 25,000 or 36,000. So in this case, it's like what I would like you to focus on would be the interest payable component. For things like car, suppose, for example, if you're buying a car of, let's say, 12 lakhs, do you really think after 8 years, it's like the resale value is going to be more than 16 lakhs and so on? But if you see here, 12 lakhs is the purchase price and the interest component that you're extra paying is almost 4 lakhs. And that's a depreciating asset. So hence, it's like the lower the term, it's more ideal. So if we rather go for 5 years rather than 8 years and let's say pay the extra 7,000 on a EMI basis, we can save 1 lakh per year. we are saving up to 1.8 lakhs on an interest on an entire tenure. Suppose, for example, rather than 5 years, we can go for an extra bit on an aggressive strategy and go for 3 years. We are paying, let's say, 36,000 as an EMI. But we are almost saving 3.3 lakhs as an interest component on the entire loan. So hence, suppose, for example, if it's going to be a depreciating asset, lower the term is going to be more ideal so that we can use our money wisely and compound for a better things. So moving on to the next slide. So one thing is, it's like obviously we spoke a lot about debt management, credit cards, and everything. But one thing is we need to take stock of family investments. Let's say, for example, for the age group of, let's say, 20 to 30 who have just started working and started their career, we also need to sit and talk to our family and know it's like what has been our history or let's say what asset classes we have been invested in and so on. Because when I did the similar exercise with my family, I figured out we are much heavier into real estate or traditional assets. So hence it's like I was the person who was able to pitch in and let's say give more idea about why financial assets is important. Because generally what mindset we have with let's say Indian families is real estate, fixed deposit is going to take care of each and every financial goal. But that's not that easy because let's say for example there are a lot of risk associated with these things. Let's say for example there are a lot of risk associated with these things. Let's say one thing is inflation risk. Let's say for example we have seen we almost all of us would have come across this channel. Let's say for my child's goal, I'm setting up this FD and it's going to take care of that. The education inflation in India is almost 11%, whereas the FD's growth rate is just 6 to 7%. We are not compounding money, we are just burning our wealth. So hence it's like we need to see strategies where we can help our family improve it and align those investments towards our financial goals. So the main reason that I would like to talk about the family investments would be we need to sit with the family and decide on, let's say, what is the current asset allocation, what is the current asset allocation, what is the liquidity that we have for each asset class, and let's say, for example, what is the performance of that. Because generally, what we say is, let's say, a person bought a property right after COVID. They would say, okay, in 5 years, I made this return. What before that? It was almost flat for, let's say, 5, 6 years and more than that. So hence, it's like we need to see strategies where we can help our family improve it and align those investments towards the financial goals. So the main reason that I would like to talk about the family investments would be we need to sit with the family and decide on, let's say, what is the current asset allocation, what is the liquidity that we have for each asset class, and let's say, for example, what is the performance of that. Because generally, what we say is, let's say, a person bought a property right after COVID. They would say, okay, in 5 years, I made this return. What before that? It was almost flat for, let's say, 5, 6 years and more than that. So hence, So as we said, it's like before starting any investments, what I would actually request you all would be to consider about the risk management. So what can you do in the risk management? First thing is emergency reserve. So let's say, for example, your monthly expense is 50,000 per month. So next 6 months expense or 1 year's expenses, you can actually keep it in short-term debt mutual funds, liquid funds, arbitrage fund, or an FD also. So once that cushion is ready, whatever contingency or emergency comes in, you don't have to go and touch your investments. You would have a safety net or a backup to fall back into, like let's say a backup plan. Apart from that, what the important thing is, if you are working, if you have dependents, if it's family, let's say if it is spouse and so on and everything, you need to have a term insurance for sure. It's like there are a lot of thumb rules saying you need 25 times or 30 times of your annual income and so. But there is very important thing called as human life value calculation. So in human life value calculation, what happens is exactly based on the requirement of family, we will be able to find out it's like what is the exact insurance requirement for you, and then it's like we can pursue that rather than going for just let's say thumb rule of 20 or 25 times and your annual income. So life insurance is a very important thing. It's not something like LIC money back policy, endowment policies, or other things like Nakul mentioned in the example of Chakravyuha, where we know to come go into that or commit into that, or let's say getting out, it's more often hectic or hard task. And why I'm telling it's like not to go towards an LIC policy like endowment money back and so on for our goals would be like, let's say for example, if I'm taking a cover of 10 lakhs with any policy of LIC or any endowment policy, I would be paying almost 50,000 to 1 lakh as an annual premium for 10 years to get a 10 lakh cover. But right now, I'm let's say 24 years old. For a cover of 1 crore, I'm just shelling out 1,000 rupees per month. That's 12,000 rupees on a yearly basis and so on. So hence, it's very cost effective and it's cheaper. One thing is you don't need to mix investments and insurance, and keeping separate it's going to be helpful for the long term. Apart from that, health insurance is very important. is a very important thing that we need to talk about. Let's say we say we have an office cover, we don't need a separate health insurance cover outside. Recently, what I've seen is it's like the person I knew had a health insurance cover in office, but they were laid off due to some issues with their company. And then it's like they were diagnosed with an illness. They were not left with any cover at that time, and they didn't have any emergency reserve too. Then they had to go and touch their investments. So having a health insurance separately, apart from the office cover, is also very important. Apart from that, one thing is, let's say, for example, you would ask, what is the cover that I need in a health insurance policy? So, for example, per head in a family, 5 lakhs cover is very bare minimum requirement. Apart from that, critical illness insurance. So, why critical illness insurance is important? This is not spoken about a lot. So, critical illness insurance is something like a, let's say you can take it as a rider to your term insurance policy. And why it is important is, let's say, God forbid, anyone is diagnosed with anyone is diagnosed with critical illness like cancer, or let's say a bypass surgery of anything of an extreme thing. In this case, what happens is, let's say if you have a 50 lakhs critical illness cover, if you are diagnosed with a certain illness, they won't see what is the bill also on and etc. Whatever the entire amount that you have as a critical illness would be transferred to your bank account. That would be your critical illness cover. Because after critical illness is diagnosed, you won't be able to, let's say, subscribe for a new illness, critical illness insurance policy and so on. So hence, aiming for a bigger cover in a critical illness policy is much important. And let's say, for example, it's more comfortable if you, let's say, pile it up or have it as a rider to your term insurance policy. Why? Because critical illness, if you take as a separate insurance policy, the premium of that is going to be very expensive and increasing as per the healthcare cost also keeps on increasing. But if you take it as a rider to your term insurance policy, it's going to be fixed till your retirement or lifetime, whatever the policy tenure you're going to be taking in. So hence, having a critical illness policy is very important. Health insurance, and if this risk management to parts is ticked off, then we can talk more about the investment components. So moving on to the next slide. Yeah. So let's say, for example, sources of incomes and let's say tax slabs. So one thing is, as a tax planning, the very easier thing for comparison between old regime and new regime is, in old regime, let's say if you have a lot of deductions like education loan, home loans, and other things, old regime sounds good or attractive. Whereas in new regime, you don't have any deductions or so. But if you see on the screen, for all the income slabs, the tax rates are much lower on the new regime. So hence, if you are in your, let's say income falls in the range of 7 to 10 lakhs or 15 lakhs, new tax regime might look attractive to you unless you have a higher deduction that you can claim in the old regime. And apart from that, it's like obviously next month the budget is going to come in, and let's say if there's any change, it's like we'll also surely do a webinar on that. But as of now, to keep it simple, 7 to 10 lakhs or 15 lakhs range, new tax regime stands fair unless you have a bigger deductions that you can claim in old regime. Moving on to the next slide. Yeah. So one thing is, example, as we generally, it's like the query that I had when I started working was, okay, I'm earning, let's say, X amount of money. Right now, I have higher commitments. I'm not able to save and invest much. What if I wait for next 5 years when I have a better income and then start saving and investing? So it's like this is one interesting chart that I found out. So let's say, for example, at a younger age, it's like, let's say, whatever the saving is, the consumption is still much lower. But let's say after 5 years, once I start a family, again the consumption and everything keeps on increasing. Then it's like, let's say, for example, at the age of, let's say, accumulation and investing, I'll be starting to save. It won't work out and it would create an imbalance in my entire financial journey and wealth creation. And also, why the importance of starting early? It's not about how higher you're able to commit. It's only about the discipline. Let's say, for example, if I am earning 100 rupees and I'm able to save 20 rupees, let's say when I'm able to say, let's say earn 1 lakh, it's like the savings ratio also is going to keep on growing. So it's only about the savings habit that we need to start and keep on growing with. And let's say whatever the age is, it's like as soon as possible, it's much better for the investments to start with. To move on to the next slide. So one thing that we generally see as an investment advisors is, let's say since last 4 years, 5 years, as we see the bull market, we all have a lot of obsession about the returns. So but we never think about stepping up our SIPs or let's say increasing our saving capacity to meet our extra financial goals and so on. So here is one interesting case study that we have put forward. So meet Ram. He has a dream of buying a house worth of 1 crore. He earns 25,000 per month. So his target is to save 25 lakhs for down payment for buying the house, and rest can be a home loan. So let's see what is going to be the illustration regarding it. So current situation is one thing is he's able to let's say save around about 7,000 after his monthly expenses of 18,000. That saving capacity is fine. It's almost 28% of his income. So next, moving on to the next slide. So yeah, let's say for example, he started saving that 7,000 rupees as a monthly SIP. And then let's say for example, we are just assuming a 12% rate of return on the investment. That's a very decent return for the long term. In this case, we are assuming a 10% step up. That is, let's say for example, every one of us, let's say assuming we get a hike in a salary. If it is 5%, 10%, 15%, we generally go and allocate it towards meeting our expenses. In this, we are assuming rather than having fully allocated towards expense, having a balance of expenses and savings both, we allocate some component towards savings. That is 10% step up on a yearly basis. So if you see monthly SIP starting 1 year is 7,000, next year 10% increase 7,700 and so on. So at the end of 10th year, exactly with 12% compounding, I can save up to 25 lakhs for this, let's say home loan down payment. So suppose, for example, let's say for example, in this case, we are not doing any step up. We are just assuming that let's say 10 years and 12% I will be able to create or let's say have a corpus created of 16 lakhs only at the end of 10th year. Apart from that, there is a better strategy to prove that obsessing about returns won't help out. To move on to the next slide. In scenario 2, if you see, we have done the same strategy of, let's say, for example, monthly investment, but stepping up at a higher rate, but assuming a lower growth rate of 10% only. That's also very decent. In this case, with a higher step up, I'm able to build 38 to 40 lakhs of corpus with this strategy. So one thing is, let's say, for example, even if you assume a lower rate, if you increase your investments every year by, let's say, 10 to 20%, so on, you can build a substantial corpus that you were expecting of. So hence, stepping up is an important tool that we need to talk more about and start inculcating in our investment journeys, and let's say make most of it. To go to the, yeah, this is one of the important slide. Let's say, for example, for a younger person who started, let's say, working out and so on, let's say they get and say are able to save about 5,000 on a monthly basis. On the other hand, let's say, for example, they receive a 50,000 annual bonus. So what would you generally prefer? Like saving 5,000 on a monthly basis for next 10 years, or investing just one lump sum on a yearly basis from the bonus? So here is a component, let's say comparison. Total investment in 5,000 SIP for 10 years is 6 lakhs, whereas obviously for 50,000 for 10 years is 5 lakhs. Investment duration is obviously 10 years. In this case, if you see estimated returns that assuming 10%, 6 lakhs would grow to 11 lakhs, whereas in 5 lakhs of the annual SIPs would go for 8.9 lakhs and so on. So almost like 9 lakhs is what we are able to build. So in this case, I just wanted to show it's like why not mix of both. Then it's like the potential would again unlock apart from having, let's say, SIP, adding step up SIP, then having a, let's say, one more layer of adding lump sum investments whenever there's an opportunity in the market is going to be also a very important factor that we need to consider in our investment journey and the growth of the portfolio. Moving on to the next slide. So yeah, so what right now we are generally seeing is, let's say, just before the election results of US, there was a bit of volatility and drawdown in the market. So what we saw was, let's say, whenever there was a drawdown, people were, let's say, having a fear of, let's say, losing out on the money and they were selling it out. But whenever the market was on top, they were just, it's like on a thing of fear of missing out and, let's say, keeping on buying at a higher valuations. And that's what's happening in the small and mid cap space. I'm not going to go deep into that because for that we have a separate webinars going on by the strategists. And in this case, what we generally say is at the high, we generally go and buy because of the greed so that we don't miss out. And it's like when it hits a bottom or let's say if there's a small drawdown, we end up selling it. So what is the outcome of this entire thing? We end up selling it. So what is the outcome of this entire thing? We end up doing a loss. But let's say, for example, rather than selling it at a rock bottom, and let's say, for example, delaying it and waiting for a good exit opportunity, you would still end up in a profit. So one thing is, it's like market cycles is going to be keeping on. Let's say it's not going to be stable like an FD that's going to give you a compounded growth rate or simple interest rate or a linear return. Market is going to be volatile. If your time horizon is long term, obviously you'll be able to let's say skim across this volatility. Hence, like averaging out all these highs and low, the best strategy is an SIP. And that's going to be the main thing for your investments, for your financial goals also. So apart from that, one more thing that we generally cross through is the concept of FIRE, financial independence, retirement early. So is it a flawed concept? So one thing was this term was actually coined in Western countries only because of having financial independence. Let's say, for example, if I'm 40 years of old age, and then it's like dependent on an income to service my entire lifetime, then I'm not independent enough. But it's like right now, the story is completely flipped. So in the FIRE concept, let's say in India, what we are saying is people want to retire at 40. After that, what it's like they're still not sure of. So in this, it's like what is the thing that I'm not, let's say, yet convinced is it's like in to reach a financial independence retirement early, you need to have a higher savings ratio. You end up saving up, let's say 80% or let's say 70% of your entire income to reach this FIRE bucket. After let's say 10, 20 years, once you retire, let's say at the age of 40, 45, you would be so used to having the saving capacity of 70, 80%, you won't be able to spend more than the limit that you already set. It's going to be a part of your lifestyle. So hence you will just end up having an extra reserve and not, let's say, for example, making most out of it. So it's what I would recommend is having a balance of mix of both is going to be the most important thing. And if we try to retain what was the basic concept of having FIRE concept is, it's like, let's say, for example, rather than having more liabilities and debt, I need to have a net worth or assets so that I'm not dependent on a specific cash flow to decide on my, let's say, lifestyle and journey. So hence, that is the basic crux of financial independence and retirement early for sure. And it's like this is something that we can explore about ourselves also. Let's say, for example, on what track we are, on let's say, are we going to achieve the FIRE, or it's not just about retirement early, it's about the independence that we get and the financial freedom about the FIRE concept. So it's like this is going to be just like a checklist. So one thing is to start with, as Nakul mentioned, set clear investment goals. Like list out all your financial goals on a sheet of paper and list it down on a sheet of paper and list it down on let's say on a rank of priority. What is a higher priority goal? What is a low priority goal, and so on. Understand your risk tolerance. Let's say, for example, if you log into any let's say portal for a risk questionnaire or a pocket risk or something like that, you'll be able to let's say answer 10 to 15 questions. You'll be able to analyze what is your actual risk capacity just by answering few 10, 15 questions and so on. So by understanding your risk tolerance and risk capacity, then you need to let's say figure out what is the asset allocation mix that would be suitable for you. Then start small and be consistent. Let's say, for example, based on your comfort level, I'm not going to say like this is the standard rate 30, 50%. You need to save from your income and so on. Everyone's finances is dynamic, and we won't be able to say a certain benchmark you need to follow. But based on your capacity, you need to start small at the earliest and be consistent, and it's like compounded at a better rate and consistently step up. And apart from that, main thing is risk management. Build an emergency reserve first. Go get a term insurance, and then it's like think about a health insurance also. Then it's like one thing is choose the right investment platform. There are a lot of things that we see. It's like Nakul mentioned, to make quick buck. There are a lot of things like cryptocurrencies, let's say small cases, and so on and everything. So there are a lot of products we need to analyze and see like what right a platform is going to be aligned towards your financial goal and aligning to your risk tolerance and so on. Then based on that, you can select the right investment advisor or the right investment platform. Similarly, monitor and adjust your investments on a regular basis. It doesn't mean like every day you need to sit and see it's like the Nifty has dropped down, it's 23,400 levels and so on. But on a regular basis, whenever there's a great opportunity, don't miss out on scaling up your investments so that it's like you can create extra buffer for your financial goals and monitor whatever, let's say, asset allocation that you're maintaining and you can continue the same. So moving on to the next slide. Yeah. So that would be from our end. So it's like we'll open up the chat box for the questions and FAQ, and please feel free to post your queries.
So we'd like to make this meeting a little bit more interactive, guys, because each person will have different queries on their financial planning as well as goals. So you can post whatever questions that we have. We'll try to answer them as best as possible. And if there is anything that you would want us to answer more, we are always happy to connect over a call to discuss, because financial planning in its sense itself is very personalized. So having a more customized solution works better for each person.
So there's a question in chat box. We would be in a position to save up to 40% of income, let's say after April salary increase. Would it be possible to get a session sometime to understand how we can allocate assets better? We are currently investing and having an emergency fund of about 3 months and trying to pay Dean and not buy a house as well. Okay. So in this case, it's like I would actually post, let's say, my and Nakul's email ID and contact details, and we'll be surely in touch. And then it's like, let's say, for example, whenever you think it's the right time to start in, it's like we can surely schedule a meeting and discuss this more in details. So hence, it's like this would be more about, let's say, a private session. So it's like we'll surely schedule a meeting and discuss more about it, and see it's like how best it's like we can help you allocate towards your financial goals. Can you guide some goals other than child education, marriage, and retirement? So it's like the question is a bit unclear. Nakul, would you like to?
Sir, so for example, uh, goals other than child education, marriage, and retirement, if you look at it, see, for whatever goal it might be, so things that is required is money. So if we can have more money, that's we'll get to the goal pretty easily. So for goals like this, what we usually do is we set a milestone amount and we take a milestone approach. Meaning, let's say if I need to get 1 crore in the next 5 years towards some goal, let's say that goal might be anything that you want. You want to start a business, maybe you want to buy some furniture, whatever that might be, whatever the goal might be. And let's say the target is 1 crore in 5 years. Now, with the current savings and the current potential, how do I get to it? Let's say assuming a conservative rate of return. Another thing to take into account is this goal a priority or not? If it is not a priority goal, then how long do I get, or how long can I postpone it? And if it's a priority goal, how can I get to it more quickly? So each nature of the goal will different. So if you can give us an example of a nature of a goal, then we'll be able to better kind of budget for it. If you guys do have any more questions, please put them in the chat. We'll wait for maybe 5 or 10 moments.
So it's like as an ideal fire number that we generally see, it's like what the thumb rule is. 25 times your annual expenses is what is to be created. So suppose, for example, how I would put is, let's say, for example, if you are, let's say, 50 years old. So that time obviously our life expectancy is, let's say, till 85 and so on. So next 35 years of expenses we need to have as a ideal fire number. So that would be the main thing. Apart from that, what is generally, it's like more on limelight would be like creating a bucket of $1 million as a first milestone. So like let's say first 8 crores or 9 crores would be a big target also, because that purpose it's like if you shift and let's say settle in India, it's going to be more than enough and sufficient to meet all your financial goals. So these are just a few numbers, but again, it would depend again on your, let's say, cash flow, your retirement goal, and everything. So it's going to be more customized, I would say. This would be just a basic idea.
Uh, Thank you guys for your time on this lovely Saturday afternoon. We are conducting a lot more webinars like this, and if there's any suggestions, we are more than happy to take it. Thank you guys for attending it and as well as for the questions as well. I hope we are able to be of some importance to you. If you guys do have any further questions, do reach out to us on your mail IDs. We are more than happy to answer. Thank you again, and we wish you guys a very happy weekend and happy Pongal as well. Thank you.
Thank you for joining. Happy weekend.